We're looking forward to seeing you at our upcoming advisory meeting. Ahead of our meetings, we are trying something new, and this is based on feedback and suggestions that we've received recently from clients, and we're looking forward to implementing. What we're going to do is send you a pre-meeting video, and this is meant to serve as an update and to provide some information to you in advance. And really, number one, hopefully this video will allow you to better digest and process some information that I'll be sharing with you today. It will also give you an opportunity to think about this information ahead of your upcoming meeting. Number two, hopefully this also then allows you to come better prepared with any questions that you may have. I'd love and welcome any specific questions that you have about the market, the economy, your investments, or most importantly, your financial plan. So instead of putting you on the spot right here at the office or during our meeting, this will give you some time to think about questions that you may have or things that you would like us to further dig into. That way we can have the most relevant information prepared and ready for you at your appointment. And then number three, it allows us to spend the most amount of time as possible talking about you and your financial plan and your investments and answering your questions instead of spending a fraction of our time together talking about general updates related to the firm or even the markets and the economy. So hopefully sending out this information to you ahead of time and allowing you to watch this video according to your own schedule and on your own time will help you to process the information and then come better prepared for our appointment. I would love to make the most of our advisory updates and our strategic planning sessions throughout 2024. And so that's our goal, is to make the best use of your time. And I appreciate you taking a few minutes to review this video. We're looking forward to meeting with you soon. I'm going to share my screen as I sit here, and I would say, if you could, plan on right around 20 minutes, and I'm going to give you an update. Let me share with you what I plan to cover during our appointment. So let me pull up and share my screen. Okay, perfect. So I'm going to touch on really three things here. Number one, I want to give an overview of the markets and the economy. Number two, I want to touch on our Bander portfolios that we actively manage and supervise. And then number three, I want to give you a couple of firm updates and then make some introductions, talk to you about a few things that we hope to accomplish this year with you and through our working relationship. So, first of all, let me start with a couple of key takeaways from the market and the economy. First of all, after posting double-digit losses in 2022, in 2023, we saw a bit of a recovery, and stocks and bonds, for the most part, had a nice rebound. Much of that was driven by the tech sector. That helped growth stocks outperform value stocks in the US. However, the value stocks still performed well, and especially outside the US, so with the international value stocks. Economic resilience in the US and elsewhere is helping boost the global outlook for 2023. And if anything, 2023 showed us why planning for uncertainty is prudent and part of what we want to do. Now, if I was to sum up the market in one word, I think the word resilient would be that one word. If you remember, going back, the year of 2023 began with many reasons why investors might doubt the market. There was anxiety over high inflation, rising interest rates, and widespread hard landing as far as recession forecasts. Later, we then endured some regional bank turmoil and, of course, witnessed the onset of a war and a lot of friction in the Middle East. Yet, despite it all, the market delivered, with the S&P being up and even double-digit returns for last year. That's why I use the word resilient to describe it. Now, as I look at 2023, going back last year, if you compare or look, you'll see a lot of the gains were here in the fourth quarter. And that's very common. I know a lot of times we'll talk about November, December, January being the top months historically for the market. And that was certainly the case last year. We saw a nice run up here at the end of last year. It was a year that defied expectations by many accounts. Several forecasters had predicted that the US economy would enter into a recession in 2023 as the Federal Reserve was raising interest rates to fight high inflation, but the economy remained resilient. Inflation eased and the Fed declined to lift rates later in the year. So the US stocks rose in 2023. We did have some setbacks along the way. Many economists who had called for a recession have since walked back from their predictions. This underscores that guessing where the markets might be headed is not a reliable way to invest. So I want to point out a couple of things, and first talk about some of the headlines or the stories of 2023. And like I mentioned, of course, inflation was at the very top of that list. Beyond stock returns, a few other storylines stood out in 2023. Coming into last January, the rate of inflation was around 3 times the Fed's target, 2% target inflationary rate. Over the year, the gap considerably narrowed and got closer. So let me point out a couple things here. I want to talk about interest rates. That's one of the key indicators for inflation. And so the Feds, you may remember, they raised interest rates very fast the first half of 2023, 1% in the first 7 months of the year. However, the underlying price decline as we start getting later in the year from October 2023 had for the first time had a decline month over month. And so that really started to level out. Let me show you one other graph here. This is useful to really get an idea of what happened in 2023 as far as the interest rates go. They were on a steady increase in 22, and then in 2023, we saw them really start to increase all the way up and through July. They got up over 5%. And so, but then we had a leveling out that took place the last half of the year. So what that has done, let me see here. I'm going to pull up something. Excuse me one moment. This slide is meant to give you an idea of really how the sentiment has changed as far as the Fed's and increasing interest rates. As we got closer to the end of 2023, comments from the Fed suggested plans to shift in the other direction, which with likely rate cuts for 2024. The market implied expectations for rates in 2024 that it shifted dramatically in the final 3 months of 2023. So figure 4, panel B here shows that at the start of the fourth quarter in 2023, the market placed about a 90% chance of rates being above 5% in June of 2024. In other words, the market, well, let me back up. By December 2023, that expectation, so here we are at the end of 2023, essentially dropped to 0, meaning that the expectation of the Fed rate being above 5% has gone from 90% down to effectively drop to 0. In other words, the market is now pricing in rate cuts to begin the first half of 2024. This is a remarkable shift in expectations. A year ago, few predicted that the Fed could keep inflation in check and begin to cut rates without causing an economic recession. The fact that we have yet to see a recession suggests that our earlier resilient descriptor can also be applied to the economy. Let me share this as far as a recap. Taken all together, these stories from last year, from 2023, big returns for stocks, improving inflation, a slowing pace of rate hikes, and avoiding a recession, highlight what a remarkable year it was. It was a year of so many memorable and unexpected stories and news events, but also one that offered a powerful lesson for investors. There will always be noise and distractions that can challenge you to stay invested in your financial plan. There will also be times when many predict market declines with no shortage of compelling arguments for why you should heed these warnings. Doing so in 2023 would likely have done far more harm than good. If we stay focused on our long-term goals and the fact that our financial plan can account for the ups and downs we will inevitably see in the markets, we can be better prepared to tune out the noise in the short term and maybe experience less stress about our portfolios along the way. Those who held that philosophy throughout 2023 were likely rewarded. We think that that approach is just as important in 2024 and in the future. Okay, so now for part two. In this next part, I will provide an update on our investment portfolios. I'm going to once again share my screen. Before we take a look, though, at the individual model portfolios, I feel it's a good time to zoom out and remind ourselves of some key principles of investing. Let me share. I like looking at this. What we know is that stocks have provided positive returns with time. However, there's more volatility, as represented here in standard deviation. We should also recognize that this variability can be spread out over time. So the long-term average returns and volatility for stocks and various bond categories. So you can see the long-term average for the returns and then the expected volatility that comes with those. So figure 4, this next slide, digs deeper into historical US stock returns. Holding stocks for longer periods has historically resulted in a greater chance of realizing a positive return. So here I show how much or how long an investor is invested in stocks and then their average return, but also the probability of yielding a positive return. So remember, as I mentioned before, previously, that unexpected news and uncertainty will push the markets up and down, as shown in the chart for the last 3 years of the S&P, with notable headlines. As you can see, there's always things, news flashes, things that are popping up and, of course, catching our attention. Recognizing that this is a reality of investing, but focusing on the big picture can help us avoid the temptation and pitfalls of trying to forecast the markets. And that's why I wanted to share this slide with you. This is an example of some of the headlines that we've had over the past 3 years. Now, our investment and advisory team, we take an active approach to managing your investments. We use a tax smart approach that takes into consideration tax efficiency when making portfolio adjustments. And at the core of your investment portfolio, we use a mix of low-cost ETFs that provide broad exposure across all sectors of the US and global economy. Our globally diversified portfolio invests in high quality US and global companies. Additionally, we utilize custom investments like structured notes to enhance that risk reward ratio within your portfolio and to provide income and total return while reducing portfolio volatility. As we go through our upcoming meetings with you, we will check in on both your risk tolerance and your time horizon for the investment funds and the portfolio models that we are utilizing. These conversations will allow us to confirm that we have the appropriate model portfolio selected for you. Now, as a general rule of thumb, we all know that investing comes with risk, and this risk can be significantly reduced when we match the investment selection with your time horizon. So please remember, don't use long-term investments like stocks with short-term money. So less than 5 years is what I would classify as being short-term. Now here are our model portfolios. This is model 1, which is our most conservative portfolio, to a model 6, which is our most aggressive stock portfolio. Here's a look at what those breakdowns look like. As you'll recall from my earlier slide, stocks have the highest return potential. However, stocks also have the most volatility or variability. Model 1 has the lowest stock market allocation, and Model 6 has the highest. As part of our active management, our advisory team has created custom investments for use in our investment portfolios. Many of you have likely heard me or us talk about structured notes as a bond alternative. This is because these structured or income notes can provide the potential for monthly income. I wanted to provide a bit of a summary of the performance of these notes. I'll also mention that these structured notes can be looked at secondarily as a stock alternative. Our team can customize the terms of the income notes to track different stocks, and these income notes have the potential to provide returns that are in line with our stock market expectations. This table shows our track record of using structured notes. We started using structured notes at the very beginning of 2022. Since then, we've created 34 different custom notes for a total investment of $62.5 million. We are pleased to report that within our model portfolios, we have received 100% of the monthly income payments, along with 100% return of the principal. The specific allocation of structured notes will vary throughout the year based on our advisory team's assessment of the stock and bond market. We use income notes with more downside protection and lower return potential in our models 1 through 3, and we seek higher returns in our growth models of 4 through 6. The table below shows that we've averaged 16% rate of return across all the income notes. Now, one thing too is that we have created some structured notes outside of our model portfolios, and of those, we have received 90% of those payments. However, in our traditional model portfolios, we have received 100% of those payments. And so we will continue to utilize the core structured notes as part of our models moving forward. This here gives you an idea of each of those portfolios and the percentage allocations. This can vary as far as how much is in stocks. And then, as I mentioned before, much of our bond exposure is coming through the structured notes. Please look for additional notes and rounds of investing that we will produce throughout the year in 2024. This is meant to give you an idea of the performance, and it goes back over a long period of time of what each of our model portfolios averages per year, what kind of standard deviation exists. So with a Model 6, we have higher fluctuations in volatility, what the best year has looked like, and then also what the worst year has looked like. And this goes back all the way to January of 1987 and runs through the end of 2023. Now, I want to go and transition over to the third part of this video and give you some firm updates as well as introductions. One thing that you will see and hear from us throughout the year in 2024 is to update the documents that each of our clients should compile or have easy access to. Now, we will encourage you to use your vault on your Bander Secure financial website, but please expect to hear from our client services team regarding these documents. And this is part of the overall planning that we provide to clients as certified financial planners. A few members of our team that you can expect to hear from this year, myself and also Doug Omont. Doug is a certified financial planner. He is entering his 8th year of working here at Bander Investments and is a valuable team member and member of our advisory team. You will likely have communication with Doug throughout the year, whether it be through video, Zoom, or even email or phone call. But please know that both Doug and I are available resources to you as certified financial planners. When it comes to client services, I'm excited to mention that Rachel, my wife, has started to help here at the office, and you may very well have some contact or communication with her. Also, Matt Douglas works as our operations manager. And then from a client services standpoint, Nicole Park is someone that you will likely hear from throughout the year. And then we've recently had Pedro Valenzuela join our team, and Pedro will assist in the operations. And so you'll likely have communication with him. And then if you visit the office here in person, you'll likely recognize Liddell as she is at the front desk and helps with the reception related items. I want to thank each of you for taking a few minutes and joining me today in preparation for your upcoming appointment. Please know that we at Bander Wealth Management are grateful for the opportunity to work with you and consider it a privilege. If you have questions throughout the year or things that take place in your life, we hope that you will reach out to us and not hesitate to view us as a resource. We are grateful for the opportunity to work with you and look forward to seeing you soon. Thank you.